Hello and welcome to this brand new episode of Business Africa. I am Ronald Kato. This week, sitting on a gold mine but begging and borrowing, we'll report on how to unlock domestic capital to finance Africa's infrastructure needs. Also coming up, frustrated by Trump's tariffs, South Africa turns to Southeast Asia to cushion its exporters. We break down Ramaphosa's trip to Indonesia, Vietnam and Malaysia. Plus, the economic crisis in Egypt is locking young people out of home ownership. Facing high land prices and expensive bank loans, developers are pricing their properties beyond the reach of many. Stay with us for the details. Thank you for joining us. Africa's recent infrastructure boom has been fueled by debt and government funds, but with lenders fatigued and demand growing, governments are changing tack. They're looking to channel trillions in domestic capital into building transport corridors and energy grids.
Africa needs between $100 billion and $150 billion per year to close its infrastructure gap. Whether it is hydroelectric dams, electricity grids, pipelines or roads, the continent cannot build enough and fast. In recent years, African governments have relied on loans from mostly China to build the highways and railways. But a debt crisis and lender fatigue has seen Beijing reduce its appetite for big-ticket projects, slowing Africa's infrastructure ambitions. But the continent has no shortage of domestic resources. It already holds $1.1 trillion in untapped domestic capital. As African leaders, policymakers and investors gather in Luanda for the Infrastructure Financing Summit, attention turns to how to turn that capital into bankable, viable infrastructure projects. Traditional financing methods such as government funds, international loans and foreign aid remain key, but struggle to address the infrastructure deficit.
Trevor Relay is an economist with Development Reimagined. Thank you very much, sir, for your time. So Africa is looking for money to build things while literally sitting on over $1 trillion. Just where is this money?
So African pension funds hold in the excess of $700 billion US. So about 3/4 of $1 trillion, not too far from $1 trillion. But less than 2% of that money has been directed towards infrastructure financing. And part of the challenge there is that the policy regulations that govern the management of pension funds makes it extremely difficult for them to invest in infrastructure because of the nature of infrastructure projects, as they said, often as high risk and the perception of them being low reward as well. So domestically, there is some money, but that money has not been effectively channeled to infrastructure financing. When you look at commercial banks across the continent, commercial banks are mobilizing domestic savings, but they're directing these savings into mostly unproductive but lucrative deployments of capital, whether it is in government securities, than lending to infrastructure financing. Pension funds and commercial banks, those two have not been effectively tapped into to serve the ends of infrastructure financing on the continent. How do we, on both the internal and external front, incentivize the reservoirs of capital, the reservoirs of financing, to put this money into the most promising, most productive, most consequential investments, which is infrastructure?
Trevor, private capital has always seen Africa as a very risky place to invest. How do you convince it to lend, much less to infrastructure?
There are many ways of going at it, but it's first to identify the different kinds of risk and then address those systematically. Is it political risk? Is it policy risk? Is it financing risk? Is it currency risk? Etc., etc. Internally, there has to be changes. First, I think, for lack of a better word, at the ideological level. Bankers that are managing Africa's financial systems cannot afford to bring the same perceptions of risk or risk aversion levels to African contexts the way they would do in contexts of other places, more so developed countries. This is because finance is the lifeline. And so if they're going to be conservative in supporting development imperatives, then they are misplacing their role within the development ecosystem. It makes no sense to continue presiding over deprived population from which you mobilize savings and be unwilling to put those savings that are owned by that same population at the service of their development imperatives. So ideologically, something has to change.
Where else can governments look for infrastructure finance?
You might have heard of things like green bonds that have come on board these days, for investors that are sensitive to environmental concerns. And so if governments and public sectors are able to factor in or demonstrate how sensitive to the environment, how they factor in environmental assessments and sustainability assessments into project preparation, they can tap into that class of investors. But also diversifying funding sources. There are many other countries now, many other markets that have become potential sources of capital for governments to issue bonds. You have samurai bonds in Japan, you have panda bonds in China, and then, of course, there's the diaspora, folks that have money that feel for their countries and want to contribute in one way, in a substantive way. So if governments, again, can package projects, reach out to the diasporas, float diaspora bonds, as indeed some countries have done, both on the continent and beyond, those two provide new avenues for raising resources to finance infrastructure on the continent.
Trevor Were, thank you very much for your time.
Thank you.
Now, the 30% levy slapped on South African exports by the US is the highest in sub-Saharan Africa. To offset the impact, President Cyril Ramaphosa headed to Indonesia, Vietnam and Malaysia in search of alternative markets.
South Africa is deepening commercial ties with Southeast Asia as tariffs continue to rock its trade with the United States. President Cyril Ramaphosa's tour has taken him to Southeast Asia's largest economy, Indonesia, Vietnam and Malaysia, where he attended the ASEAN summit with hopes to tap into the region's $3.9 trillion economy.
You're touching on what I call the Indian Ocean economy, which I think has not been fully leveraged by all those Indian Ocean economies, South Africa being at the tip of it, as it were. I think, we've always focused as African countries, because of colonial relationships and so forth, on the Western economies. And I think this is an opportunity for us to refocus our attention, to better appreciate that the opportunities are on our doorstep. And I think this is part of that effort. And in a way, Trump has done us all a favor by pushing us in that direction. Huge economies, developing fast, high GDP growth, lots of industrialization, lots to learn from these economies.
Trump's 30% tariff, the highest in sub-Saharan Africa, took effect on South Africa's export in August. The U.S. is South Africa's second-largest trading partner by country after China. The tariffs will in particular eat Pretoria's agriculture, automotive and textile sectors. South Africa's central bank has warned that the U.S. levy could cost as many as 100,000 jobs, with unemployment already at more than 30%.
Now, there is no scarcity of houses in Egypt, but there is a shortage of homeowners. Around 10 million housing units are sitting idle without occupants. Young workers just cannot afford the prices demanded by developers. Mariam Ehab and Youssef Ala Eldin now report from Cairo.
Inflation in Egypt has driven a surging demand for real estate as investors seek to shield their wealth from currency devaluation, leaving approximately 12 million housing units vacant. Millions of young Egyptians, as a result, are locked out of home ownership. I had an experience where I wanted to buy an apartment, but of course it didn't work out because, first of all, every apartment requires a down payment, and I didn't have that. The crisis intensified in September 2023 when inflation hit 38%, accompanied by severe foreign currency shortages that affected land prices and building materials. Some real estate developers are greedy with their profit margins. They want to earn as much as possible, so they set very high margins. The second issue is that the value of the dollar was rising against the Egyptian pound at times, and there were two exchange rates, the black market rate and the official rate. Despite government efforts to expand access to housing through subsidized projects, demand continues to far outpace supply. In the face of a social housing crisis, the government has made a significant effort, delivering over 600,000 units, yet demand outstrips supply by hundreds of thousands. The annual need is around 1 million units, but actual constructions fail to exceed 150,000, leaving a massive shortfall. Although Egypt's real estate market remains profitable, contributing 20% of GDP, young Egyptians struggle with steep upfront costs and unaffordable installments.
And that wraps up this episode of Business Africa. I am Ronald Kato. The news continues on air and online. Bye for now, and I'll see you on the next episode of Business Africa.